and or you're comfortable with contributing the same portion of your own pay to your account, and it has to equal the same portion for everyone else, and your employees cannot contribute. It all falls on the employer, the business owner. So that's the SEP. The next one we're going to be talking about is the simple, which you would think has the word simple in it. Do you have it pulled up exactly what it stands for, simple? Because there is a name for it. I just had it pulled up.
Savings incentive match plans for employees.
There it is.
It's simple. Savings incentive match plans for employees.
Of small employers, yes, the simple. So the SEP is the simple employee plan, and the simple is the savings incentive match.
That makes it easy.
Just keeps it confusing. It's like Medicare. Like they come up with all these letters, and then they just use the same letters over and over, and it just makes it confusing. But it's okay. It keeps us employed. People need to figure out the terms that they use, and so that's why they call us simple. What makes this special? The simple IRA is kind of like a honed down, slimmed down version of your corporate 401ks that you would get at a big corporation. And people want to work for your company, they want to work for your business, but they also want benefits. And how can a small business compete with a big corporation that offers all of these benefits? Well, simple IRA is more efficient for a small business. It's also less red tape, a lot less red tape, very simple to get set up for your company, right? And it's also less expensive for the employer to set up. Why did I save it for the latter? I put it after the SEP because I believe the solo 401k, if you have no employees, SEP IRA, if you and your employees are really tight and you don't have a lot of them, probably, no turnover. You guys, this is your deal. Maybe family owned business. And then this one is the simple IRA. And the simple IRA is more for that broader scope where you do have turnover. You do have a lot of employees. You can have up to 100 employees.
Yeah, the limit, not more than 100. 100
right.
Or fewer.
100 employees that are probably not your ride or die people. So these are more standardized, more I guess normal of what we expect in a 401k or what we understand.
I worked one of my last jobs after I retired from the military. An employer offered me, and I participated in the simple plan that I moved not to
yes.
before the end of the year.
Yeah.
I rolled it from one account from one custodian to the other custodian, no consequence, and I reinvested it into a rollover IRA.
Yeah, and the thing of it is, a lot of these IRAs, these different types of IRAs, can all be funneled into one account because they're all tax deferred. They're all treated the same. They're all considered a vehicle, right? The same vehicle. It's just that, or the same concept as a vehicle. It's just they're different types.
For example, right, we're sitting with a client that, we're talking about potentially having their solo 401k open as a one participant 401k. And they're going to move, they are able to move a rollover IRA and then an old 401k into the solo 401k because, like you're saying, these are the same type of money.
Right.
Same tax classification.
And one of those 401ks that they're putting into the solo 401k is actually from a company. So if you went out on your own, that's a really good point. If you went out on your own, you left a company to go start your own business, then you can actually consolidate that 401k into your own 401k with your company. And that's a huge benefit. So good point, Frank. The simple. Now, I said we're going into the simple. Why? Because this is when you have more employees.
Is the most simple? No.
Not necessarily. It's because I think it's the best suited when you have a lot of employees, but not to the point that you're this huge corporation. But if you have less than 100 employees, this might be a better fit for you. So the simple, something that really makes it different than the SEP IRA is that the employer is not required to have that mandate where, they can do their own thing, but they can match But one of the biggest things is that the employees can contribute as well. So that's how, if you worked for a company, you said, oh, I contribute to my 401k, and then my company matches 3% or up to 6%. This is that concept. You can contribute from your paycheck and start saving. It's a big benefit for a company, especially a small company, to be able to offer for their employees, the people that are working for the business, to be able to also contribute and reduce their tax burden, because now they can deduct those contributions that they're making to their simple IRA, and then the company is matching that and making it even more. So now not only is the employer, the business owner, getting the tax savings, but so is the employee.
Double benefits, sure. The
Yes.
employer and the employee.
And the employee. But they have to have earned at least $5,000. So it's not $750. So there's a little bit of difference, but yes,
You
go
ever
ahead.
heard of an alibi? You know what? I have an alibi.
I have an alibi. I was on the radio. That was my alibi.
I have is that I just wanted to mention, though, as we are talking about helping folks start that solo 401k, that solo 401k can be set up so that if they hire employees, they don't have to reestablish the plan. They can add it into a regular 401k. This company we're working with, right, the solo 401k that they're establishing, they set it up so that if they were to expand the business and bring in employers, they really don't have to change. There won't be a huge administrative and a restart up of the plan. I think we were talking.
But now you're talking about the solo 401k
Yeah, I'm sorry,
again.
that's why it's an alibi. So an alibi is when you're in the army or on a range, when you're firing your weapon and you misfired and your weapon didn't fire and the time is up because everything's timed on a range. So you have extra rounds. So you have an alibi firer.
Well, we've been doing this show for quite a while, Frank.
Rounds.
What do I?
So I had a point from a previous.
I know. So I tell Frank, you'll enjoy this. I tell him,
Firers only.
I like to compartmentalize things because I think it's an easier way for people to comprehend and not get confused. And Frank likes to jump around. Frank goes back and forth all over the place. So I tell him we have to compartmentalize. So you just went back to the solo 401k, and you made a good point. Yes, I agree with you.
Savings incentive match plan for employees. We're still talking about the simple plan.
Now we're back to the simple.
Savings incentive match plan for employees is simple.
So the simple IRA, which is different from the solo 401k, how? Let's see if Frank's been listening to me.
You can't have more than 100 employees, and the employer does not have to.
Well, that's the SEP.
Yeah, it doesn't.
Well, what's the difference between the solo 401k
There's more letters
and the simple? The solo 401k is when you have no employees. No employees. The simple IRA is for when you hire a bunch of employees. The SEP IRA is when you have no employees or a few employees.
But there's options. These aren't like the sole. This is not a one size fits all. Like you can't. Employers could have a 401k as well.
One of the things for it is that, again, 100 employees or less, there are fewer rules. Again, it's simple to manage as an employer. So if you have a lot of employees and you need to provide a benefit for a 401k sort of plan, the simple IRA is probably a really good opportunity for you. There is no Roth option, and the earnings has to be at least $5,000, so they do have to reach some sort of level of vesting. And the limit for 2023 is $15,500.
So lower limits.
A little lower limit, and then also, but it's still better than a traditional IRA. The traditional IRA is only $6,500. So the simple IRA gives you an opportunity for $15,500, and if you are above 50 years old, they allow you to add even a little more called the catch-up contribution, and that's $3,500.
50 or older.
50 or older.
3,500 additional.
So that is the simple. So let me break it down one more time, and then we're going to talk about a whole other IRA that has its own set of rules. So the solo 401k, if you are self-employed and you have no employees, you and your spouse could utilize the solo 401k in order to build your own retirement account. And then, very simple to do. The next one, the SEP, which is the Simple Employee Pension. Frank looked it up. I always get confused. I want it to be a self-employed plan, but
Simplified employee pension.
there we go. So
SEP
the
is
SEP.
simple. The simple is not.
I'll be honest, I don't see a lot of SEP accounts. I've seen 2 in my entire career. Both of them were very well funded and they had a lot of money in it that were business owners. They did very well with those accounts or with those strategies utilizing a SEP. But I'll be honest, I rarely see them. And I think it's just because a lot of business owners, nobody's teaching you how to utilize them. But there's a lot of benefit in a solo 401k and a SEP IRA if you are a business owner, a small business owner. We were talking about running a restaurant and we were both like, oh, it's so much work. I said, but they could probably, all the business owners could use a SEP or a solo 401k.
If they can keep their employees.
Yeah, and taking care of yourselves and giving you that tax benefit and obviously creating a retirement. At the end of the day, you need to build a retirement for yourselves. It doesn't matter at what age group you're in. It's not too late to start your retirement savings. Then the simple IRA, that's when you really have a lot more employees. Maybe you own a factory or some sort of business where you have lots of laborers and you want to offer them and some benefits to compete with the bigger companies, the corporations. The simple IRA is going to allow you to do that. So go ahead.
There's flexibility in that. So the savings incentive match plans for employers. So the employer is going to match in a simple. I'm just giving you again in my the way the simple plan worked for the employer that I was at. They could match up to 3, but they had the ability in like off years, if the profits were down, they could match as low as 2% or 1%. You know,
yes.
They have some flexibility.
That's where they say the red tape. You know, that's why these plans are designed for small business owners. If you're in a different element of your business, then a 401k is going to be the best thing for you. Which, by the way, we can also offer. But today we're really focusing on the smaller business people, and these types are sometimes get looked over because it's like you're either targeting the really big corporations in the 401k space or not at all. And we want you to understand that you do have options, and especially because you just did your taxes, we also want to remind you
someone in the local area that'll come and sit with you and explain these things to you and help you get a plan in place.
And it's easy,
not just over the phone.
It's so easy. Okay. So now that we've kind of summarized that, let's talk about a Roth IRA and what makes that special. So a Roth IRA is different because unlike all of these other retirement accounts that we've been talking about, a Roth IRA is a little backwards, I would call it.
Not deferred.
It is the opposite of you put the money in before you pay income tax. See, that's the standard retirement account strategy is you put the money in this account before you ever pay income taxes on it.
Vehicle as well. This is a newer addition to the code.
So you put the money into this account before the taxes are paid on it, and then later when you retire, you pay the income tax. Well, the Roth IRA does not work like that. It's a little backwards. You do pay your taxes now. So now you've paid your income taxes on the money. You don't owe Uncle Sam anything, and you invest it into this Roth IRA. Well, why would you do that? Where does the tax savings come in with a Roth IRA? Well, a Roth IRA starts at the baseline. So you put it in, and let's say you're contributing to it year after year after year after you've already paid your income tax. This money, you don't owe Uncle Sam anything on this money. It's your money. But why would you put it into this Roth IRA? Because once you put it in there, again, you are now subject to that 10% penalty. The government is having a say in money that is all your money. Why? Because as that money grows, any gains that you earn on that money over decades, possibly until you retire, is completely tax-free. So the gains is where your savings is. You're not paying any taxes on any of the gains. That's how a Roth is designed to work.
It's a big potential if you think that your tax rates are going to go up in the future. Mm-hmm. It might be wise to.
So how would that work? So we talk about taxes. We talk about an individual, let's give an example. So you have someone that is, let's say, 45 years old, and they're working and they're making money and they're in the higher tax bracket. Can you pull up the tax brackets of what they are? I know we went over them a few shows back, but let's say that.
I'm right here.
Oh, good. So give me the upper tax bracket.
For married filing jointly or
Let's just do single.
single? The highest tax bracket starts at $578,125.
And then what's in
37%.
37%, but you have to, so all the money that you make over 500 and how much?
78,125. 578,125.
How do they come up with that number? Right? Couldn't we just do like 580,000? Just to make it kind of, again, they have to make it confusing. Okay, so 578,125.
578.
I got it. Okay. So that's how much you make. Anything above that is going to be taxed at 37%.
That's right.
Anything above it.
The base amount they have here as well is a 174,238.25.
What's
I'm not sure how that's calculated. But
what
that's
is
the base
the
amount.
what's the bracket below the 578,000?
35
35% down to what? I mean, how much money?
to 231.
231,000.
251.
251.
231, 251.
Okay, so $231,251.
$231,251 to the 578,125.
Gotcha. Okay, so that's the gap. All right, so if you are in that tax bracket, which honestly, that's pretty normal for a business owner, 250,000, and then it goes down to what? 170. What's the next bracket?
32 is 182.
182. So let's say you make it to 200,000. You're in 30%. You're in 30% over there. Now what? What's below 180? When do you get down to the 20s?
24 is from 95 to 182 is 24.
95,000.
Round numbers here. 95,376 to 182.1 is the 24%.
24%. Okay, so you could save yourself quite a bit of money. So let's say you just get up to the 182. You know, I'm making $300,000 this year. You got your calculator pulled up? Because I'm going to have you do math, Frank. So you know,
Take off my shoes. Hold on.
182,000, and you know I'm going to you made 300,000 in your business. And this is your income. How much would be 300,000 minus 182,000?
Oh, was I supposed to be starting?
Yes.
Okay.
Yes.
Sorry.
Come on, you're lagging.
What's the calculation again?
300,000 minus 182,000. And the reason that I'm doing this is because I want to show you a real example.
118.
118,000. So we know that 66,000. Now subtract out 66,000 because that's the max that we can dump into one of these retirement strategies.
52.
So that leaves 52,000.
Yes.
So 52,000 is still going to get taxed at that 32%. But what's 66,000 times 32%? Do, 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 do. Oh, do you want me to get my calculator out?
62,000 times.
No, 66,000
66. Okay.
times 32%. Essentially a third. Times 32%. 0.32. He's doing it on his computer, so he's going a little slow. But I think it's worth the wait. Somebody's already calculated it.
21,120.
$21,000?
120.
Okay, so you just saved yourself $21,000 in taxes.
Sorry about that. That took a
No,
long
it's
time.
okay. But okay, so if you were making 300,000, and don't quote these numbers. These are very, hypothetical and inaccurate, but high level view of the concept. So if you earned $300,000 in your business, and we know that up to 24% is 182,000 and so on, that gap, you could dump at least up to $66,000 and protect it from that high tax burden of 32% and save yourself $21,000 just on that one SEP IRA maybe, or that one solo 401k. Not to mention, if you are doing the simple IRAs, all of the money that you can write off in those. So that's just one hypothetical of doing that. Go ahead. What do you?
It's just another situation where potentially, in the right situations, you could be contributing to contributing to a 401k and still have room to contribute to a Roth IRA.
Yes, you could contribute to both.
Exactly.
Which is also more, not a more of a deductible, but more tax savings. But the tax savings on a Roth doesn't come in the tax year that you do it. Right?
Right.
It comes later on. Why do people do a Roth conversion? Let's talk about Roth conversions.
Yeah, I do Roth conversions because I believe the tax brackets are going to go up. We're going to see higher. Historically, America is in low taxation phase now.
And we're talking about income taxes. Ordinary
Federal
income tax. Yes.
And so, if I'm going to be in a higher tax bracket, potentially when I start taking distributions from qualified accounts, from tax deferred accounts, from my rollover IRA, then I will put them in. Then I take some of those amounts and put it in my Roth every year. I try to do so if I don't believe my tax burden is going to be that high.
Yes, exactly. And just like I did that calculation, that quick calculation that probably bored everybody to death, this calculation, you can create these gaps in your income. Right? You know that the tax brackets are what they are. They're not flexible. They're pretty easy to calculate because math is honest, and I love that. So you do the math and you say, hey, I have this much income or based off of, let's say you're still in that 22% bracket, but you only are,
several $1,000s.
I don't know what the number is, but let's do the 24% because he already told me it's 182,000 up to.
So we're talking about single category again, Joe. Yes. By the way, we've been talking about the single tax filing category. 24,000, or excuse me, the 24% bracket starts at 95,376. 376, and
it goes up to 182.
Yep.
So let's say that you are in that bracket of 24% and you have 120,000 in income. So now you have $62,000 left in that 24% window.
In that same bracket.
So you could essentially, this is how a Roth conversion would work. You would, how much did I say? 62,000.
Right.
So we would take 62,000 from your IRA, convert it to a Roth IRA, and pay 24% on that. Really, that's high. We wouldn't want to be in the 24%. We'd want to do it the 10 or 12.
Amounts,
but I'm right. But I'm trying to just show you the concept. What you're doing is just trying to fill that gap, take advantage. Say you're in that 10% or 12%. Like some people that are retired are going on, they have their Social Security, they take their required minimum distributions, and then maybe some annuity income pensions, and say they're getting $40,000 a year in income, a single person. What tax bracket is that? 40,000.
They go from 10 to 12.
So now they're in the 12% bracket. How much money do they have before they get to a higher bracket in the 12% window?
$4,725.
4,000? So then you could.
725 is the next bracket. 726.
The idea is to pay Uncle Sam what you owe him because he's getting paid. If you pass away, this IRA money that we've been creating through this whole show, whether it's in a SEP or a simple or a 401k, it doesn't matter. Uncle Sam eventually is coming for that
We're not
money.
saying not to pay him.
But what we want to do is pay him at the lowest tax rate possible. Legally. And that requires some strategy. So you set up a Roth conversion. If you have even if you just have $100,000 IRA over maybe 5 to 10 years, you can slowly pay Uncle Sam each year at a 10 or 12% tax rate versus when you pass away, if it goes to your kids and they're working and they're making $150,000 a year, now they inherit your IRA, that comes to them as 100% ordinary income. It gets just like a paycheck to them. So now now Uncle Sam, you're paying him back at maybe 32, 37%, just depends on where it falls in their income for that year. So having the strategy of doing a Roth conversion, that's what that is converting that debt that you owe Uncle Sam called income tax and paying him off bit by bit over time at the lowest possible tax rate, which if you can do it at 10 or 12%, that is a huge win, huge win. And think about it, for that self-employed person that owned it, and you don't, once you turn 59 and a half, that's when you really should start converting. When do you think, Frank, is the good time to like really start converting your IRAs into your Roth?
Well, in the years that you don't mind the additional taxes, or the
gap.
You're going to pay additional tax.
Yeah, I feel like when people are still working, they don't typically do it because they're already in that higher tax
there may
bracket.
be years where you're taking losses. If you're going to take losses,
right,
then that would be the good year. Like if you know that you're in a position where you're taking losses,
yes,
then that would be a good year.
Yes,
You had some.
Very good point. Especially obviously for business owners. So it's just strategizing and being mindful of how it works and taking these concepts, these tax, the tax laws are already there. The code is already written. It's just understanding it and using it to your best interest and paying Uncle Sam what you owe him at the absolute lowest tax rate possible. And there's a way to do that. It's just called math and it's called planning, and that's what we specialize in. So I really hope that maybe some of you found some good value and knowledge in these topics today. We talked about the solo 401k. That is for people who don't have employees. And we talked about the SEP IRA, which is, I think, better if you have a few employees that you're really, really close to. And then also the simple IRA, which is more designed for your small business owners who want to offer benefits and let their employees contribute to their 401k plans. And then we just talked about the Roth. This has been a wonderful afternoon, and I thought we were being cut off, but I guess not. We still have a few minutes, so it's always good. But going back to taxes, part of our overall strategy is to develop a holistic plan and to know that everything that you have is working together in conjunction to make your money make you money and not everyone else. That's the theme of our industry, is that everybody's making money on your money, and I want that to change. I want you to make money on your money. So I really appreciate it, and thank you for listening. This is the Mindie Molina Show, and remember, God loves you, and there's nothing anyone can do about it. Be well.